This lecture is an overview of the financial statements that are prepared by a business. So we're going to talk in general about what each one is used for, just introducing each of them. There's a separate lecture on the balance sheet, one on the income statement, one on the cash flow statement. So there is more information coming on this topic. So the term financial statements refers to the business documents that report financial information about a business to decision makers or stakeholders, whichever term you prefer. These are the end products of all of the financial reporting that goes on in an organization. So one of the things that I frequently say about financial statements is they're only as good as the information that gets to them. So in your business or your department, if you're a manager, if you've got transactions that have not made their way to your accounting department, they will not be reflected in your financial statements. So we often think about, are there any transaction streams that aren't being captured? Could somebody have put an expense on a credit card and that credit card statement hasn't made it into your system? We use these statements to make decisions, and of course we want to make the most accurate decisions we can, so we need to be dealing with the most accurate information. So the three we're going to talk about, the balance sheet, the statement of earnings or income statement, and the cash flow statement, all do different things. Quickly, what the balance sheet does is show you what you have and what you owe. What the income statement does is show you if you're making money. Are your revenues greater than your expenses? And the cash flow statement shows you where your money comes from and where it went. If that sounds the same as an income statement, the reason for that is you don't yet understand the difference between profitability and cash flow, but we will be talking more about that as time goes on. So a couple of these statements are flow reports, which means they cover a time period. So your income statement and your cash flow statement are usually done for a year, a month, a quarter. They're not done at a moment in time because you measure things like your sales over a time period. So you have monthly sales, annual sales, that type of thing. Whereas the balance sheet is a status report. What the balance sheet tells you is at a moment in time, what do you have and what do you owe? This balance sheet, the world's simplest balance sheet, has three categories. There are always three categories on a balance sheet. The assets represent what you have, the liabilities represent what you owe, and the equity is the difference. If you think about your home, the value of your home is the asset, the mortgage is the liability, and the difference between those two numbers is the equity in your home, which is a concept you hear lots about if you're trying to borrow money. How much equity do you have in your home? A business has equity as well. You, again, add up what you have, subtract what you owe, and the difference will be the equity in the business. If the liabilities are more than the assets, then the business has what we call a deficit or a deficiency, and obviously you don't want your name on that balance sheet. The income statement has many names. It is known as the income statement, the statement of earnings, the statement of operations, profit and loss, receipts and disbursements, revenues and expenses. There are any number of names for this statement, but what it does is show you what you've charged to your customers, which is the revenue. In this case, that $2 million. You subtract from that your expenses, the $850,000, and that gives you an income before tax. If you're not a taxable entity, of course, then tax isn't relevant to you. Businesses are taxable. You've got the income before tax, less the income tax gives you the net income. The net income is what we often refer to as the bottom line. Okay? That's the money that's made after all of the taxes and expenses are considered. Now, the thing to remember about the income statement is that all the sales that are recorded there as revenue, they haven't all been paid for yet necessarily. That's what's billed in the year, not what's collected in the year. So that's different than the cash flow statement, which we're going to talk about next. The expenses, again, are the ones you've incurred in this time period, not the ones you've paid. So this statement tells you if you're making money or not. The cash flow statement shows you where did my money come from and where did it go. And we've got, as I said before, another lecture on this with more detail. The top category there, operating activities, is the difference between the money your customers have paid you and the money you've paid to your employees and your suppliers. Hopefully, this is a positive number because you should be collecting more from your customers than you're paying to your employees. This would be a goal. The second category there, investing, that is cash flow from buying or selling your assets. Typically, we see negative cash flow from investing because people are buying assets. When you buy something, the money goes out the door. That's a negative cash flow. Most businesses would borrow money, which is a financing activity, to buy assets. So you've got a positive cash flow from financing coming against a negative cash flow from investing, which is you going out and buying these fixed assets. In this particular case, this business has very strong cash flow. So they are able to generate cash from operations. Again, more collections from their customers than they paid to their suppliers and their employees. They're also investing in the business, so they're buying assets, and they're paying off their debt. This is because their cash flow is so strong. So if you look at this statement from the bottom up, we have the cash at the end of the year, which shows up on your balance sheet, the cash at the beginning of the year, which shows up on last year's balance sheet, which usually is presented at the same time, and the difference. In this case, the difference in cash in the year is that $980,000, and that means that even after they paid off some debt and bought some assets, they still had their cash go up. You would want your name to be on this particular cash flow statement because this business is doing very well. So this lecture talked about the overview, what the balance sheet does for you, shows you what you have and what you owe, what the income statement does for you, tells you if you're making money, and lastly, the cash flow statement, which shows you where your cash flow came from and where it went. And again, we're going to go into more detail in subsequent lectures.